All right, today we are diving deep into a financial strategy that moves trillions of dollars around the globe, mostly completely out of sight. It's called the yen carry trade, and trust me, it has a much bigger impact on everything from stocks to real estate than you probably think.
So let me just start with this question. What on earth connects Japan's economy to your investment portfolio? Whether you're in New York or Sydney or anywhere in between. Well, the answer is this pretty fascinating and kind of risky financial engine. To really get it, you can't think of it as just one transaction. You have to imagine a massive, invisible tide of money. This isn't some niche thing for a few traders. We're talking about a force that can literally lift up global markets or cause them to come crashing down.
At its heart, the idea is actually surprisingly simple. Basically, investors borrow money in a currency that has super low interest rates, and that's the Japanese yen. Then they take that money and invest it in other places where they can get a much higher return. So, borrow low, invest high. That's pretty much the whole game. Okay, but how does this actually work in the real world? What are the steps that let this huge flow of cash even happen? Let's break down the mechanics of what is essentially a 0% interest loan. So, first things first, you have to ask the most basic question here. Why the Japanese yen? Why not the dollar, or the euro, or anything else? And the answer really comes down to Japan's economic policy, which has been this way for a very long time. For decades, the Bank of Japan has kept its interest rates pinned at or right around zero. Now, they do this to try and get their economy going, but it has this huge side effect. It makes the Japanese yen the world's cheapest piggy bank for big investors.
The process itself is like a simple three-step playbook. Step 1, a big hedge fund or an institution borrows a massive amount of yen, paying almost nothing for it. Step 2, they immediately swap that yen for another currency, say US dollars. And then step 3, they take those dollars and buy things that pay a way better return, like US government bonds or American stocks.
And all of that, of course, brings us to the most important part of the whole story, making money. So how exactly do investors cash in on this simple little three-step process? Well, there are actually two ways they profit. The first one is the obvious one. It's just the difference in the interest rates. That's called the yield spread. But the second way, that's where things can get really profitable, or really dangerous. And that comes from the currency exchange rate itself. Let's use a real-world example here. Say you can borrow Japanese yen for basically 0%, and you turn around and invest that money in US bonds that are paying, 5%. Well, you're just pocketing that 5% difference. And when you're doing that with billions of dollars, that is a huge and what seems like a very low-effort return. A really simple way to think about it is this. It's like borrowing money from a friend for free, 0% interest. You put it in a business that's making you a 5% return. The catch, and we're about to get to this, is that very last part. You're just hoping that the cost of paying your friend back doesn't suddenly shoot up. Because, yeah, while this sounds like the perfect money-making machine, it has a gigantic built-in risk. This is what the finance world calls the unwinding of the carry trade. And when that happens, it can shake the entire global market. See, every great financial strategy has a weakness. And for the yen carry trade, it's got this one single fatal flaw that can turn massive profits into catastrophic losses pretty much overnight. The number one risk here comes down to just one thing. This whole trade works because the yen either stays weak or gets even weaker. The second the yen starts to get stronger, the cost of buying back those yen to repay your original loan, it skyrockets. That 5% profit you thought you had, it can just evaporate or worse, turn into a massive loss. And this is what triggers a really dangerous domino effect. It starts with some kind of shock that makes the yen suddenly strengthen. That causes investors to panic. They all rush to sell their US stocks and bonds at the exact same time, trying to get dollars so they can buy yen and pay back their loans. This fire sale makes markets tank. And all that sudden buying of yen makes the yen get even stronger, which creates this terrifying feedback loop. So you can start to see why this isn't just some little strategy for currency nerds. The sheer scale of the yen carry trade means that its effects ripple across the entire global financial system. When the carry trade is on and popular, it's just flooding the system with cheap money. It pushes up the prices of everything: stocks, bonds, real estate. It helps fuel the good times. But like we just saw, when it reverses, it can take a market downturn and turn it into a full-blown crash. It's kind of like a hidden engine for both booms and busts. And that is why this all matters on a global scale. A tiny little change in phrasing from the head of the Bank of Japan in Tokyo can send absolute shockwaves through Wall Street. So every smart investor, everywhere, has to keep one eye on Japan, because a decision made there could easily trigger the next great unwinding.
So it all leaves us with this one kind of provocative final question. For decades, the entire global financial system has gotten used to this river of cheap money flowing out of Japan. So what happens on the day that river finally dries up? That's the question every investor on the planet is watching for.